The next step in creating your killer business plan is creating your financial model. The first step in this is your pro forma income statement, sometimes called a P&L statement, and it should look at where your company could be in 3 to 5 years, and not necessarily the best case scenario, but if everything went right, where will the company be? Now, the first step of that is obviously your revenue model. And this is really one of the most difficult pieces because you are going to have to create, using an Excel spreadsheet, some sort of model based on real world metrics, best case scenarios of where your revenue is going to come, how you're going to track that revenue through different traction metrics. So if you're a website, you're going to say, we expect to get click-through rates on ads at a certain amount, and then for every person that shows up, we expect maybe 0.5% to actually purchase our product or register for our site. But you're going to try to have to go through some sort of logical process in your model that explains where your customers are coming, how you're getting them, and kind of conversion rates and how that leads to revenue. And every startup is a little different. But you can use some of the best practices you'll find of conversion rates for websites, for retail stores, for really any business. You can find out what is a normal conversion rate, what are some of the normal assumptions, and build that into your model. One key component of your financial model is your market share analysis. Now, this is going to be really the key part of your figuring out your whole forecast model. And this is where you figure out what really is the market available for my product and how much am I aiming to get. And from that, all your other numbers flow. So how do you figure it out? Well, first thing is you have to decide if you want to use the number of people in your market, the amount of revenue in the market, or maybe the number of units sold. And you can do all three, and sometimes I recommend you do that. So the first thing is you identify your target market size. So let's go to the Amazon example and go, well, if Amazon is selling books to book readers, let's use 100 million buyers in the United States. That's their total market size. And there may be a growth rate or a reduction rate, depending on the industry, that you might want to calculate into your 5-year or 3-year pro forma. That's really up to you. Once you have that total market size, you then need to go to your total addressable market, or your TAM. This is really the demand for your product. And in the case, I'm going to go back to the Amazon example, is his total addressable market is the people online who are book buyers. And that may, back when he started, may have just been maybe 5 million users. So we've narrowed down his potential market and target market to 5 million. The next step in narrowing that down is your served available market, which is really what portion of the target addressable market are you going to actually try to serve. In the case of Amazon, he was selling books to anyone, so the number wouldn't be any different. But if you're a premium, you make luxury goods, you're only going to be looking to address maybe 5% of your total addressable market. So, if there's 100,000 people in that case, and you're looking for the top 5% based on wealth, their earning or spending capabilities, your target market is now just 5,000. But you see how this calculus just kind of works its way down. You start as the very biggest number, you narrow it down to those who you really can address, those who you're going to target. And then once you have your target, you have to go to your share of the market. Okay, your share of a market is how much do you actually think you'll sell? And there's two constraints on it. One, who are the other players in the market? So if you say you're going to get 50% of the share of the market, you're going to need to explain who are the other people have the other 50% of that market. Is it underserved? If it's already served, are there players in it? If there's already big players in it, have 90% of the market, and you say you can get 50%, that's a real big challenge to convince investors that you can do. Generally, as a startup, you're trying to say, I can get a few percentage points at most of any share of the market in the beginning. You may get very fortunate and go beyond that, but that's not what you want to aim for. So this calculus is the foundation for your entire forecast model, is narrowing it down of your market share analysis. Take time on it. It will take some research to identify the different numbers and really targeting, but also set up your model so you can play with these as well, just to see what ifs. What if we had 2 products versus 1, or what would happen in expanding, so you really know true details about how your market behaves and what is going to be your opportunity with it. The next part of the income statement is your cost of goods sold, sometimes cost of services if you're a service-oriented company. Now in this case, you're going to identify any of the direct costs related to delivering, selling your product to the customer. If it's a product, obviously the cost of manufacturing it goes in there. If you're selling books on Amazon, it's the cost of the book, it may be shipping. Component, that would be cost of goods sold. And that's pretty simple as long as you know what your product is, you'll be able to add that in. The next major section on your income statement is your SG&A. SG&A stands for Sales, General, and Administrative Expenses. This is where you put all your ongoing recurring expenses running the business that you need to track in your pro forma model. So you start with salaries and wages. Now, that can be a really complex, project of trying to guess where am I going to put it. So salaries and wages should be its own tab within the income statement or within your Excel document. And then you summarize that into a summary sheet, which we'll talk about in just a moment. One thing to remember about the salaries and wages is you're going to have employer taxes. General rule of thumb is that about 10% of what you pay someone, you're going to have to pay in addition in employer taxes. So just kind of build that in so you're not shocked when you think you're going to have $100,000 in expenses, in salary, and all of a sudden it shows up as $110,000 out of pocket because you didn't account for taxes. The next component is overhead, and this could be a lot of different line items: rent, internet, telephone, but this is also where your legal fees will be listed, your accounting fees, any insurance you're required to carry. Now, in the startup, you might not have many insurance, but if you have employees, you're going to have workers' compensation, which may be 2 to 5% or more, depending on what type of startup you are, so you need to really account that in. That's mandatory. You cannot have a business and have employees without it. The next section will be your marketing, which we put all your expenses monthly that you'll spend on promoting your company. Also, you may want to really think about it, and one of the errors that shows up in this spreadsheet or this component of the income statement law is just a standard number. Someone puts 1,000 across every month. And the thing is, you really should know your business enough to know that if you're going to be at trade shows and you do 2 a year, that you're going to have increases in expenses every 6 months or something like that. You're going to have these little peaks and valleys. So when you're putting numbers into your pro forma model, it really should be based as much on reality of your operations and not so much as we think on average we'll spend 5%. You should try to get as detailed as possible. The next section is travel and entertainment. Simply what it is any money you expect to spend on travel and entertainment. It could be employee meals, that could be taking potential clients out to dinner, it could be travel to trade shows, whatever it is, that's where you put that budget component. The last section is the R&D section. It's not a traditional GAAP or general accepted accounting principles section, but this is your budget. There's no real rules. You just have a general flow of starting from revenue, working down expenses till you get the bottom line number. And because R&D is so important in early stage, and it's where you may spend a lot of your money, whether it's developers or outsourcing or product development, creating molds, that it's kind of good to have its own line item so you can track that and know what's going on. When you take all those numbers, you go from your revenue numbers to your cost of goods sold minus that, then you have your expenses, you minus that out of the revenue numbers. You're going to end up with a last number, and we call that the EBITDA, earnings before income taxes, depreciation, amortization. It's not your net income, which is generally your bottom line number. Net income includes taxes, amortization. In a startup, it's really hard to guess those. What you really want to know is what is our revenue minus expenses. In the startup, it's normally a negative number, maybe for the first year, maybe for several years, but that's what you're trying to do. One thing to add on, which is not an income statement item per se in accounting rules, but is capital expenditures. These are anytime you have to buy major equipment or some other intellectual piece of property that isn't considered an expense by tax reasons because you'll be amortizing it or depreciating it, but it is a cash flow item. And this tool is really for your purpose, the income statement. You will share it potentially with investors and other partners that are intimate with you, strategic partners, but ultimately you really want to have this as a tool that you and your management team could look at and understand really where is all the expenses in the company. So be free with it a little bit to make sure it works for you. There's no rules right and wrong, except for that the general flow is revenue, cost of goods sold, SG&A expenses, on your bottom line. So you've done all these details. How do you present that in a way it makes sense? Well, if it's an Excel spreadsheet, as it should be, you're going to have a tab for any of your staffing expenses. Any other details you think really need to be broken out, make sure they're in tabs, make sure you explain your assumptions. But what you're going to do is you're going to have one page that is a summary for at least 3 years, but up to generally 5 years of your pro forma, where you think your company is going to be. And then you're going to have another tab for year 1, another tab for year 2, another tab for year 3 that summarizes month by month your pro forma income statement budget.